Bitcoin just pulled off one of the most confusing moves of the month. In the middle of panic, in the middle of fear, in the middle of headlines telling you this market was breaking down, nearly $1.5 billion flowed into spot Bitcoin ETFs in just 5 trading days. That is what happened. Big money stepped in while smaller traders were running for the exits. And yet Bitcoin still could not cleanly reclaim $70,000. That is the contradiction. That is the trap. And that is exactly why this market is so dangerous right now. Most people are looking at the price and thinking the rebound means the worst is over. Other people are looking at the same chart and saying this is nothing more than a dead cat bounce before another hard flush lower. Both sides sound confident. Both sides have arguments. But only one side is going to be right. And the data sitting underneath this move is sending 2 very different messages at the same time. On one side, institutional money is showing up. Real size, real allocation, real demand coming through regulated ETF products, while fear is still elevated. On the other side, derivatives traders are still acting like they do not trust this bounce at all. They are not chasing upside with conviction. They are not loading the boat like a new bull leg is already started. They are hesitant, defensive, waiting. That split matters more than the price itself, because if you only look at the rally, you may walk straight into a fakeout. And if you only look at the fear, you may miss the kind of silent accumulation that usually happens before the crowd understands what is changing. This is one of those moments where surface-level analysis gets people hurt. The chart looks simple. The internals do not. Here is the first thing you need to understand. Bitcoin did not rebound because the whole market suddenly became wildly bullish again. The move back toward $70,000 was helped in a major way by traders who got trapped on the wrong side. When fear accelerated and Bitcoin dropped toward the low 60,000s, a lot of short-term traders did what they always do in a panic. They leaned into the downside. They shorted weakness. They positioned for a deeper collapse. They assumed the stress would keep building. Then the collapse they were betting on did not arrive. The situation that had traders bracing for a larger risk-off shock failed to escalate in the way they expected. And the moment that became clear, those short positions turned into fuel for a rebound. The people who sold first now had to buy back. The people who bet on more downside now had to cover. That is the anatomy of a squeeze. It is not always fresh belief pushing price up. Sometimes it is trapped pessimism being forced out of the market. And that distinction is everything. Because a rally driven by conviction behaves differently from a rally driven by mechanics. Conviction says investors see value and want exposure. Mechanics says traders got caught offside and had to react. One is the beginning of a trend. The other can be a temporary launch that burns out when forced buying is done. If you cannot tell the difference, you are trading blind. Now here is where the story gets more interesting. While fast money was getting squeezed, slow money was buying. Quietly, methodically, without drama. Roughly $1.45 billion moved into spot Bitcoin ETFs across 5 sessions. Think about what that means. This was not a burst of retail enthusiasm from people throwing lunch money at a headline. This was larger capital choosing to add exposure while the mood was still negative. That is not a small detail. That is the center of the story. Because institutions do not move like social media traders. They do not usually buy because a green candle excited them for 6 minutes. They buy through structure, through allocation, through products that fit compliance rules, fund mandates, and portfolio models. When ETF flows stay firm during price weakness, it tells you there is a layer of demand underneath the chaos that many retail participants never even notice until much later. It does not mean institutions are magical. It does not mean they are always early or always right. But it does mean there is a difference between emotional selling and strategic accumulation. And right now, that difference is visible. So why has Bitcoin not exploded through $70,000 if this much money is coming in? Because markets do not move on one data point. They move on a tug-of-war between spot demand, derivatives positioning, macro uncertainty, liquidity, and trader psychology. Right now, one side is buying structure. The other side is still doubting the bounce. That creates friction. And friction is exactly what you see on the chart. Let's go deeper into the internals because this is where the clean headline starts to fall apart. Start with momentum. Bitcoin's relative strength index recovered from a weak reading near oversold conditions and has started moving higher. That is good. It tells you the selling pressure that dominated the prior drop is no longer hitting with the same force. But it is not a full-throttle bullish reading either. Momentum has improved, not transformed. It is recovery, not dominance. That is an important difference people keep ignoring. A market coming off stress often looks stronger before it actually is stronger. Momentum turns up first, confidence comes later, confirmation comes even later. And in between those phases, traders get baited into calling bottoms too early. They see improvement and mistake it for resolution. They see relief and call it strength. That is how fake certainty gets built. Now look at spot activity. Participation improved, volume picked up, the imbalance that had sellers leaning hard on every bounce began to ease. That matters because relentless selling pressure is what keeps markets pinned. Once that pressure starts to balance out, price gets room to breathe. Stabilization becomes possible. Panic loses momentum. And a market that was falling under its own weight starts to behave more normally again. But normal is not the same as bullish. Balanced flows do not mean buyers have seized control. They mean the bleeding is slowing. They mean forced exits may be fading. They mean the market is no longer acting like everybody is desperate to dump at once. That is a step forward. It is just not the final step. And then you get to derivatives, where the tone changes again. This is the part that kills simple narratives. In futures and leverage positioning, the market is still cautious. Demand for aggressive leveraged longs has not surged. Traders using leverage are not behaving like a new runaway upside leg is guaranteed. The appetite to chase with borrowed money is muted. That is healthy in one sense because it keeps excess froth out of the system. But it is also revealing because it shows the more speculative crowd is still unconvinced. That is the split. Spot flows look steadier, ETF demand looks strong, short-term momentum has repaired somewhat. Yet the leverage crowd is still holding back, still hedging, still acting like another shove lower remains possible. That tells you this market has not resolved its internal argument. And when a market has not resolved its internal argument, the next catalyst matters even more. That is why prediction market data becomes so useful here. Price charts tell you where Bitcoin is. Prediction markets tell you what people with money on the line believe could happen next. And right now those odds are improving at the margin, but they are not screaming certainty. The most aggressive bearish scenarios have softened somewhat. The probabilities attached to deeper downside have come off the highs. That is encouraging. But a meaningful portion of the market still believes lower levels remain in play before a cleaner breakout happens. Read that again carefully. The market is becoming less bearish. It is not becoming confidently bullish. That is a massive difference. And most people collapse those two things into one. They see fear easing and immediately assume the trend has turned. Not necessarily. Sometimes fear simply stops getting worse. Sometimes panic burns out before optimism returns. Sometimes the market moves from collapse mode into waiting mode. And waiting mode is exactly where Bitcoin looks stuck right now. That is why this price zone is so tricky. If you are a bear, the ETF inflows are a problem. Because you cannot look at $1.45 billion entering these products and pretend demand is dead. You cannot keep screaming that nobody wants exposure while large pools of capital are stepping in during weakness. That argument does not survive contact with the data. But if you are a bull, the derivatives caution is a problem. Because you cannot look at the leverage side of the market and claim everybody is aligned for upside. They are not. Not yet. The market is still showing restraint. There is still skepticism. There is still hedging. The rally has not converted the doubters. So what do you do with that? You stop asking lazy questions. The lazy question is, bullish or bearish? The better question is, what is driving the move? Who is participating? Who is not participating? And what would need to change for this move to become sustainable? That is how serious analysis works. Right now, the rebound has a mechanical component from squeezed shorts. It has a structural component from ETF inflows. It has a stabilization component from improving spot conditions. But it still lacks the kind of broad speculative conviction that usually powers cleaner breakouts. That is the honest picture. Not doom, not euphoria, tension. And tension is where expensive mistakes happen. Because in a tense market, people overreact to every candle. One push higher and they call for all-time highs. One red day and they scream distribution. That noise destroys judgment. What matters is not who can shout the loudest. What matters is which signals are durable. ETF inflows are durable. They reflect a framework for access that institutions can keep using. Spot stabilization is meaningful. It shows panic selling is not in full command anymore. But the caution in derivatives is also real. It means the path higher may stay messy, volatile, fragile, vulnerable to shock. That leaves Bitcoin in a zone where both upside and downside remain open, but the quality of the information has changed. The market is no longer giving you one clean story. It is giving you competing evidence. And that is usually a sign that a bigger move is still being prepared rather than completed. Think about the psychology here. When retail traders panic, they usually react to what already happened. They sell after damage. They chase after relief. They let headlines do the thinking for them. Institutions often operate differently. They ask whether dislocation has created opportunity. They scale exposure through vehicles built for patience. They do not need to tweet their thesis. They do not need to sound dramatic. They just need entries that make sense over a longer horizon. That difference in behavior is one reason this market keeps humiliating emotional participants. And Bitcoin, more than almost any other liquid asset, punishes emotional certainty. It moves too fast for slow thinking and too unpredictably for lazy thinking. When the crowd becomes convinced the market is broken, it can bounce. When the crowd becomes convinced the danger is gone, it can roll over. That is why you need frameworks, not slogans. Here is a simple one. Whenever Bitcoin makes a violent move, ask 5 things. First, was the move driven by conviction or by forced positioning? Second, what is larger capital doing underneath the headlines? Third, is on-chain and spot behavior improving or deteriorating? Fourth, are leveraged traders confirming the move or fading it? Fifth, what do real money probability markets say about the road ahead? If you ask those 5 questions, you stop getting trapped by single candle narratives. You stop confusing noise for signal. You stop letting the chart alone tell the whole story. And on those 5 questions, Bitcoin currently answers like this. The rebound includes forced positioning. That makes it real, but not automatically trustworthy. Larger capital is buying through ETFs. That is a strong structural positive. Spot and momentum conditions have improved from stress levels. That is constructive. Leveraged traders are still cautious. That is a break. Probability markets are less bearish than before, but still far from declaring clear skies. That is uncertainty with a slight improvement, not clarity. Put it together, and the picture becomes sharper. Bitcoin is not in clean breakout mode. It is not in outright breakdown mode either. It is in a contested zone where the floor is being tested by bigger buyers, while conviction above is still missing. That means the next major catalyst matters even more than usual. If macro pressure eases further, if flows stay firm, if derivatives stop leaning so cautiously, the market has room to push. But if uncertainty flares again, if the bounce fails to attract broader participation, if traders keep treating rallies as opportunities to hedge rather than build, then this range can crack again. That is the reality. Not everybody wants to hear reality. Reality is not as satisfying as a bold prediction. Reality does not go viral as easily as a one-line call for moon or doom. But reality is where the useful edge is. And the useful edge right now is this. The market is showing early signs of stabilization, supported by notable institutional demand, but the evidence is still incomplete. Enough has improved that you cannot dismiss the rebound. Enough remains unresolved that you cannot trust it blindly either. That is why the next few weeks matter so much, because this is the kind of setup where confirmation can come late and fast. If broader confidence returns, the people waiting for perfect safety will likely be forced to react at higher prices. But if this move stalls and the market loses balance again, the people who bought the first green bounce as if the battle was already over will be the ones feeding the next flush. In other words, this market is still asking a question. Was the recent weakness a panic event that created opportunity for patient buyers? Or was the recent rebound just a squeeze that gave the market one last chance to distribute before another leg lower? That is the fight. That is the whole fight. And until that fight is resolved, the smartest approach is not blind confidence. It is disciplined attention. Watch flows. Watch derivatives. Watch whether spot demand keeps absorbing weakness. Watch whether probabilities keep improving or stall out. Do not let one metric hypnotize you, because nearly $1.45 billion already made one thing very clear. Serious money did not run from this market when fear was loudest. It moved in, quietly, deliberately, while everybody else was busy shouting. Now the only question is whether that silent accumulation is the beginning of something bigger, or whether it is about to collide with a market that still has one more shakeout left. That answer is coming. And when it comes, it will not care who sounded the most confident on the way here. So keep your eyes on the structure, not the noise. And remember this: in markets like this, the people who survive are usually not the ones who react the fastest. They are the ones who understand what is actually happening before the crowd does. If this breakdown helped you see the market more clearly, subscribe and stay close. And tell me in the comments, does Bitcoin break above $70,000 first, or does $60,000 get tagged before that happens? And when you look at the $1.45 billion ETF inflow, do you see smart accumulation, or just temporary support before another trap?